I'm Mike Uppel in the 680 newsroom. This week coming up could see higher interest rates from the Bank of Canada. It sets monetary policy on Wednesday, and many expect it to raise its benchmark lending rate from the emergency low levels for the first time in 7 years. A lot of reasons why our central bank could raise interest rates right now. We've got good economic growth, strong labor market job creation, good retail sales results as well. One sticking point could be a weak inflationary environment, but nevertheless, Bank of Canada might want to raise rates this week simply because that would allow them room to maneuver if, in fact, the economy were to weaken, for example, in 2018. And what, if anything, will higher interest rates do to the Toronto real estate market? Numbers in this week from the Toronto Real Estate Board pointed to a steep decline in sales on a year-over-year comparison, down 37% from the June data a year ago. Prices were also off the recent records that were reached in April. A more balanced market right now being seen in Toronto, with more sellers coming into the market and buyers being a little bit more cautious. Analysts say that there was a psychological change when the Ontario government announced recent rule changes to mortgages and that 15% foreign buyer's tax. Canadians, however, are not slowing down when it comes to buying new cars and trucks. In fact, the first half of the year was a record breaker. Over 1 million vehicles sold across the country, according to data compiled by DesRosiers Automotive Consultants. That is being fueled by, well, just replacements of older vehicles on the road and more Canadians than ever before driving as population growth continues, and just cheap financing as well. Amortization rates. You can finance a vehicle for 7 to 9 years at low monthly payments with very low interest rates. And that is a trend that is not likely to change anytime soon. Industry watchers are saying that we could see 2 million car sales by the end of this year for the first time in history. Tesla stock has been down. It was the top performer in the first half of the year. Recently, though, it's dropped 20% from its record highs as the company has faced supply constraints with its batteries and failed to meet production targets in the second quarter of the year. This past week saw Tesla launch officially the production of the Model 3. Whether it can keep up with demand for that highly anticipated vehicle remains to be seen, and there are new challenges to Tesla in the electric car space, with Volvo announcing by 2019 all of its vehicles will have some sort of electric components within the engine. And Toronto stocks continue the struggles. Worst performing market so far, the G7 nations. This week saw another drop for the TSX Composite Stock Index, down more than 1% as the price for oil took a nosedive by as much as 6%. That price for oil still something to watch, and maybe a reason why the Bank of Canada won't necessarily move on interest rates this week. I'm Mike Uppel in the 680 newsroom for City News.